So thank you for joining the seminar today. We appreciate your interest in Gloin. I am James Wigley, part of the Gloin investment team. And before introducing the speakers today, I'd like to give you a brief update on the outlook for Gloin. 2023 has been a challenging year for share price performance in the utility industry, and consequently, it's been a challenging year for Gloin as well. However, the fundamentals of Gloin are strong and the green shift is accelerating. This combination of strong fundamentals after a challenging year of share price performance leaves Gloin well positioned into 2024. If we isolate the main factor for the challenging 2023 is actually been the macro background, which has been of rising interest rates throughout the year. In the short term, long duration assets such as utilities act like bond proxies. However, if we step back and look at the correlation over the medium time, it's much more nuanced. For instance, in 2022, we saw the 10-year Treasury in the US rise by around 200 basis points. Despite this, the share price of the utility sector did reasonably well during 2022. However, in 2023, we've seen interest rates rise by only about 50 basis points, but the sector has done much more poorly. The key point is that over the long term, the fundamentals of this sector really count. It's really the earnings and dividends which will drive the share price performance. And despite these higher rates, the utility fundamentals are relatively unimpacted. And this is because around 75% of the debt of utility companies is actually passed on to consumers. So the fundamentals remain intact and are strengthening, and the green shift is actually accelerating. A brief reminder of what the green shift is. It's a two-wave transition to a decarbonized economy that will accelerate growth of the utility industry. Now, wave one is the cleanup of the existing power sector. It's reducing the emissions by replacing the coal generation with renewable generation. Now, this transition is well underway, but we have much further to go. Now, wave two is the electrification of the wider economy as we move to clean energy. This will allow us to power things like electric vehicles, providing low emission transportation. And when we have a cleaner energy fleet, we can also power other industries. For instance, we can electrify industrial processes and replace fossil fuels with green fuels, such as green hydrogen. Around 25% of the economy's emissions are actually produced in wave one. This is coming from the electric power sector. However, in wave two, we'll go after the other 75% of the economy. So the utilities are the enablers of the decarbonization of the economy. The end result is that the utility industry will take share from the wider energy industry over time. We've seen strong growth in electric vehicles in the last few years, and we expect this penetration to continue to grow in the future. In order to have that strong penetration, we also must have the infrastructure built out to support the vehicles. In California, we've recently seen favorable legislation pass. This legislation will improve the remuneration of PG&E's charging infrastructure. This will incentivize them to build out further infrastructure into the grid. Now, utilities get paid by building infrastructure, and that creates a rate base, and they earn a return on that rate base. That's how utility companies make money. Green hydrogen is also coming much sooner than we thought. Originally, we thought it would come in around the 2030s, but we actually see this now being accelerated to the end of the 2020s. A good example of a company that's poised to benefit from this is AES. AES is just a joint venture with Air Products, which is a large industrial gases company in America. It's going to build about 1,400 megawatts of renewables to power the electrolyzers to produce the green hydrogen. This green hydrogen will become a feedstock for industrial processes, including things like ammonia and for feedstock into refineries. Now, AES, they have a low-risk business model, so actually we don't want to take on technology risk, and companies like AES will actually have a very contracted business model in things like green hydrogen. So they will build the renewables, and they will have a fixed revenue and fixed cost outlook as they'll lock in their costs going forwards and their revenues. Now, we believe that Gloin's well positioned because regulated utilities are the best way to profit from the green shift in a low risk way. Now, low risk in the sense that Gloin's investments are in companies that do not make technology bets. They have no risk of technological obsolescence, and they don't compete with other companies. They actually operate in exclusive franchise monopolies. That's why many of our companies have been around for over 100 years, and the future is brighter than ever for these companies as well. Now, regulated utilities get a fair return on every dollar that they've invested in their business. This leads to that consistent earnings and dividend growth that we've come to enjoy over time. And all costs are passed on to consumers, including about 75% of the debt costs. That minimizes that headwind going forwards. This is why we set up the Gloin portfolio as it is today. You can see that about 81% of the portfolio is in regulated utilities in the best franchise areas who are benefiting from the green shift and with strong growth prospects ahead. Another 14% is in highly contracted business models where the returns are locked in for the future, and these companies are also well placed to grow. All in, we're minimizing the risk and still enjoying the benefits of the green shift for the portfolio. So the outlook is for visible and consistent returns, with accelerating fundamentals driven by the green shift. Constructively, as we look into 2024, the valuation is also attractive. So here we are looking at the relative valuation of the US utility sector. Most of the time, and on average, it trades at a slight premium to the S&P 500. Currently, however, the discount is approaching 20%, despite these strong fundamentals. In summary, Gloin has been around since 2005. We are long-term investors in regulated utilities who are benefiting from the green shift and when the outlook for earnings and dividends is visible and consistent. Now, in 2023, performance has been challenged by higher rates, which has led to a de-rating of the sector, but not to the fundamentals. And with this backdrop, and however the economy develops going forward, the current valuations and dividend growth provide a constructive outlook. Thank you for your attention.